Okay, we are live on the interwebs, on Facebook, on YouTube, and on LinkedIn. I know from last time that it takes a couple of seconds till it appears and actually goes live, so we're going to wait with the content until it's actually live. Let's see here. I'm waiting to see. Oh, yeah, so I am live on YouTube. I just got a notification. Oh, we're live everywhere. We are live. We are live. You hear me okay, Amir?
Great.
Oh, man, my AirPods disconnected. Stupid technology. Hold on. Talk.
Hi, can you hear me?
That's good. All right. So we are live on Facebook, YouTube, and LinkedIn using a platform called StreamYard. I just want to tell you that StreamYard does not support virtual backgrounds. So how do I have a virtual background? I Googled it. I downloaded a program on my Mac called Snap Camera, and I put a virtual background, and then I configured this platform to use that camera. So I had to mess around a little bit. But so we have comments. You see the comments, Amir, on the right side?
Yeah.
So here's the overview. Amir and I go way back, probably like 20, 25 years. And he he has a startup. So here's the overview. Amir and I go way back, probably like 20, 25 years. Amir, can you hear something? And why? Oh, you did that. Okay, I heard it from you.
Yeah, I understand. I'm sorry, it's a mistake. Sorry.
I was so confused. All good. So yeah, we know each other for a long time. I am now working with him as an advisor on his Jerusalem-based early stage fund called Champel, with some incredible investments like Innoviz and many others. Let me just see what the comments are saying here. Loud and clear. Hi from Morocco. Terrific. Hi from London. Hi from South Africa. Stereo. Beautiful. Thank you for the feedback. And from Belgium. I love it. Okay, so I've been working with Amir for a while now, and Champel is now raising an additional fund after having deployed capital in some of the most amazing companies. And Amir is going through the process, which is highly technical on the one hand, but I think it's very important to kind of share his experience, and I'll tell you why. Because there is literally endless literature on the internet about how to build a startup. And most startup entrepreneurs don't really dedicate much thought to the world of a VC. In other words, I hear all the time people saying to me, I want to be a VC. And I'm like, do you know what a VC does? A VC sits in Excel sheets and boardrooms, and 90% of his time. Entrepreneurs don't really dedicate much thought to the world. Put your volume down on that, man. So I say to people, VC is not an easy job at all, especially, raising a VC fund from LPs, from limited partners. When a startup raises $1 million, $2 million, $3 million, okay. But when a fund raises, we're talking about tens of millions, hundreds of millions. And so it's really, really not easy at all to build a fund. And I thought, it would be good for maybe entrepreneurs and other people to understand the process of building a fund and what it entails. And no one better to share that than Amir. So Amir, let's start from the beginning. Give me your background on a personal level. Where are you from? What's your story?
Okay, great. In a couple of minutes. I was born actually in Israel, but I grew up in Switzerland, in Geneva, spent 20 years there. And then I came on Aliyah. I left Switzerland. I moved to Israel 23 years ago. And actually, that's when we met at the time when we studied in the same place for over a year.
Yep.
And that's back in 1998. And then, have a MA and BA in international relations, and I started working in finance back in 2004. 2010, I started working for Bank Hapoalim as an investment advisor. That's my job. I mean, my title. Originally, I'm a portfolio manager and investment advisor for almost 7 years, and then I left the bank and I joined my childhood friend, best friend from kindergarten. Who actually did very well in life. And he called me one day, early 2017, and he said, Amir, listen, I did well, and I'd like to invest money in the startup nation. Can you help me? So I said, I wanted to anyway do something new and more exciting. So I left the bank and I joined, and we started working together, I'd say around June 2017, originally investing his own capital, then bringing in family and friends. And we created the first fund. It went well. We have 3 exits to our name so far, and more coming.
Give me names.
Yeah, the first company is a company. First exit was a company called SmartApp, which was acquired you made a subject a vlog on that company a long time ago already. It was bought out by Masco, an American fund. Fascinating story, about talking about technology, because this is doing smart showers, smart water, really. So it's really digitizing the very, very, very traditional industry. Is fascinating because it's actually going very well, and now they are so happy, the acquirers, that they actually gave to the team an envelope to do corporate VC and look for other
Wow.
technology in Israel. So it's a great stuff. And then, of course, we invested in Lemonade, which went public just over a year ago. And we invested in Innoviz, which went public in April this year. And we have another company, which is the next few months should be exiting. A very, very good deal. And overall, the portfolio is doing well. So, we decided to build on that success and to raise a fund. And, as we were discussing, it's very, first of all, it's purely technical process. What does it mean to have a fund?
Wait
Means
1 second, Amir, hold on 1 second. Before we jump in, I just want to
okay.
talk about one of those companies that you mentioned. All three of them are amazing. Most of your investments are incredible investments, but I want to talk for 1 minute about Innoviz, because I think it's fascinating, and I'm sure that almost no one understands what Innoviz does. And so
Yeah.
I'll give it to you guys kind of pretty simplistically. I'm not going to obviously get too technical, but everyone knows that the future of transportation is autonomous, right? You don't have to be a rocket scientist. Everyone knows that soon we won't be driving our cars. But what people don't know is how that's going to happen. What makes a car autonomous? And so the answer is there are three options. Option number one is cameras all around the car. Well, that's extremely limited in terms of its functionality, because if it's raining outside or it's dark outside, cameras can only give you so much clarity. And it's absolutely not going to be what's the word holistic enough of an approach to be able to drive cars around the world autonomously. So cameras are kind of old school. Then there's radar. Now radar, some of you might remember, you use radar to see if there's a cop car ahead or other things. It's great for big things, but it won't tell you if there's a pothole in the road, right? It's not optimized for smaller things, right? Its resolution is very, very low. And then there's LiDAR. Now, whenever you see a Google self-driving car or Yandex self-driving car, or any of these cars, you see a big, big contraption on the roof. That's LiDAR. Well, clearly that's not practical at all for a car to have this massive thing on its head. And so what Innoviz is doing is taking the LiDAR technology and making it this big. And I saw the cars that have Innoviz's LiDAR on them, BMW specifically, you didn't even know it was there. And so BMW is going to be the first OEM, the first car manufacturer with fully autonomous. And let me just explain what that means. My Volvo has, autonomous level 1 is like cruise control. Autonomous level 2 is what I have and what Teslas have, which is you have to stay in the front seat. You have to be next to the steering wheel. It could drive itself, but you have to keep your eye on the road. Autonomous level 3 is you could sit in the back seat, right? Completely and totally autonomous. I had the unbelievable privilege to drive in the next generation of Mobileye, which was fully autonomous. We drove from outside of Jerusalem to Jerusalem.
With Professor Shashua.
Yes. Merging into traffic. It was unbelievable. But that's not commercial yet. But when we have fully autonomous cars on the road, it will be powered by Innoviz. This is an Israeli company that Amir invested in that went public. So that's just one of the many unbelievable investments Amir and his team have made. So now, Amir, you're at the stage right now where you're raising another fund, correct?
Exactly.
Okay, so what are some insights that you've learned from the process?
Well, first of all, I'd say just to answer your previous question about, people who want to go into the industry because it's glamorous and everything. Well, first of all, it's very, very difficult, because what does it mean to have a fund? I'm going to go a little bit into the technicalities. I think it's important to mention that. But beforehand, I want to say that, first of all, having a fund means having investors, having clients, right? And it means earning their trust and showing that you can create value for them on large amounts of money, because you cannot have a fund with $3 million or $5 million. Doesn't make any sense. You need to have at least a few tens of millions of dollars, otherwise you can't start a fund. Really, it doesn't really any sense commercially, because there are expenses, regulation, lawyers, teams, offices, etc. The whole thing costs a lot of money, and to finance all this, you need to have enough assets under management. Otherwise, it's not really serious. Otherwise, you can do what I did originally, which is to have one or two guys, and you invest just their money personally, and that's great. But it's not a VC fund. So first of all, it means raising money, and it's not easy. That's the most difficult really part.
Let me just jump in here for 1 second, Amir. This is also really, really, really important because I don't think entrepreneurs understand this, right? So an entrepreneur is building a company, and their goal is to return the money that they raised from an investor to that investor. And when they make an exit, then they go and they return their money, and whatever's left is theirs. That's how a startup works. What people don't realize is just like a startup has to return its money to its investors, funds have to return their money to investors. And so, if you're a startup entrepreneur looking to raise capital, you have to understand the mindset of an investor. The mindset of an investor is, I need to return my money to my investor. I don't care about anything else. You could be saving the world, but if you're not going to generate enough capital, enough revenue for me to return my money to my investors, I'm not investing, period, full stop. And so entrepreneurs have to understand that. It's not like, oh, that VC didn't invest in me because he didn't like the way I looked or because whatever. No, he didn't invest in you because he didn't think you were the next Instagram or you were the next WhatsApp, because the mechanics, right, of a VC are very, very simple. First of all, it's a 7 to 10 year period. That's one thing. Your investors don't see their money for a decade, but you have to make a massive return in order for anyone to make money here. You can't you're not like a kiosk who makes, 2x their money. That's not interesting to a venture capitalist, because a venture capitalist has to make enough money to return to the investors and then obviously make some money themselves. So it's really, really not easy to be a VC. Okay, go on, Amir.
No, first of all, I agree with every single word. Of course, you said it. It's really not easy. So again, first of all, you have to raise money, and then you have to see where you raise this money from. Why is that important? Because the question is, what is a fund? A fund is a partnership, technically speaking, in legal terms. Now, why is that important? Because it depends where you're going to set up your shop. Now, this being a global business, you have the whole world is technically open to you. You could have an Israeli partnership, and there are a number of Israeli funds which have opened Israeli funds in the sense that the partnership, the legal entity, is based in Israel. That's an option. Then you have the most common jurisdictions in the world are Delaware in the United States, the Cayman Islands, and Luxembourg. Now, all of these jurisdictions have got pluses and minuses, and really which one to choose depends on who are you going to be your clients. But how do you do when you have an example like me, when I don't know yet who are going to be all my clients? I have already raised part of the money that I am intending to raise. So I have already part of my client base, right? And I know what they like, but I also know where I'm going to look for the rest of the money. But I have to make a gamble here, because I don't know exactly what's going to happen. So now it's a very expensive gamble, by the way, because just creating a fund is a lot of money. So we chose to start with Delaware in the US, because that's where most of the funds of the world are being created. It's very, very accepted jurisdiction in the world, and for most clients it's okay. Certainly clients in the US, but it's not okay for all of them. Some of them do not want to be in the US for some reasons. European clients from the European Union, not all European clients, because England or Switzerland or Monaco.
Amir, just to clarify, you keep saying clients, you mean LPs, correct?
LPs, yes. I mean LPs is partners.
LPs is limited partners. It's the people that invest. It's like the fund of funds, the people that invest in funds. In Israel, the most well-known LP, most well-known fund of funds is Alan Feld at Vintage, who I actually have a call with today at 4:30. Who I love. He's amazing.
Yeah, he's a great guy.
That guy, by the way, just 2 seconds, he managed somehow, I don't know how, but he managed to get into funds like Andreessen Horowitz, that was, widely regarded as one of the top venture capitalists in the world. And when they were raising money, as you can imagine, it was incredibly oversubscribed. Everyone wanted in. And somehow Alan Feld from Herzliya managed to get in as an LP of Andreessen Horowitz. And that's just one. He is LPs. He's an LP in tons of top tier VCs. It's unbelievable. And, when I asked him about it, he said one word. I said, Alan, how did you get in on these funds? He said one word. Any guesses what that one word is, Amir?
Yeah.
Relationships.
Relationships.
He invests in relationships. So let me just, before you continue, guys, if anybody's watching and has questions, you can ask questions and we'll address them. I just want to read some of the questions here. We have one question from Stav Yechezkel. He said, Amir, are we talking on a 4-year fund, 3 exits, short time period for great exit? No?
Yeah. I mean, I did well. I mean, I can see it's Stav Yechezkel saying, yes. What can I tell you? That's what we did. I mean, everything is public. There's no secret.
The name of the game in VC, and this is again something that I don't think many people understand, is the higher the risk, the less attractive the terms for entrepreneurs. So in other words, if I'm an entrepreneur and I come to Amir and I say to Amir, listen, I have an idea, and it's just an idea. So you say, okay, well, you have an idea, but until you build a product, until you get traction, until you get product market fit, until you get monetization, there's a whole journey here. So if right now you're just an idea, that means all the risk is on Amir, which means that you're going to take more percentages of the company because you're taking the risk. On the other hand, the greater the risk, the greater the reward. And that's why, there are people, and I'm not going to name names, that put in tens of thousands of dollars into a certain company, an Israeli company that went public recently, because they were the only investor that would invest. They invested tens of thousands of dollars, not hundreds of thousands and not millions, tens of thousands. And when the company went public recently, this one investor pocketed $300 million. $300 million. Okay, so why does that make any sense? Because that's tech. Tech can scale exponentially. Excuse me. Unlike other industries, if you have a kiosk, it can only go so far. Whereas, a tech company where the distribution is super easy, you have an app store, you have whatever. I'm not talking about hardware. The sky is the limit. And so the name of the game for a VC is to try to mitigate risk, to try to invest in things that are lower risk so that the journey to success, whatever success might be, whether it's an exit, an IPO, or just a large sustainable business, is shorter than 10 years because they came with traction, with product market fit, and the risk for you is lower. So that's kind of high level, the name of the game. Okay, go on, Amir.
Yeah, completely. So, so again, the story of jurisdiction. For instance, Europe has got most funds in Europe are being legally created in Luxembourg. But the problem is the European Union has created a completely crazy regulation. On one hand, it so-called gives security to investors. I'm not saying it's not safe. It is safe. But the flip side is that the cost is completely ridiculous. And therefore, to create a Luxembourg fund, you really, really need to have a lot of interest from European clients. But we may end up having to create parallel structures. One in Delaware, where we are starting, and another one in Europe. And who knows? And some, it really depends where's your client base. So that's just the first point. I just want to say that I spent weeks now, literally weeks, talking to lawyers, talking to everywhere in the world now, literally, whether it's Cayman, BVI, Europe, different places, Switzerland, Israel, America. It's a very complicated issue. I've heard a lot of different conflicting opinions. Of course, everybody is also trying to sell his own shop because if your shop is based is geared for the Cayman Islands, which is a leading jurisdiction in terms of fund creation, then you want your client to create a fund in the Cayman Island, of course, right? But we that's what we decided, and we hope that eventually we will be able to give something that is amenable to everybody as much as is possible.
Amir, I want to ask you for 1 second. I know you've kind of answered this, but I want you to dumb it down for me because I didn't understand. Mm-hmm. What is the practical difference where I incorporate my fund? I know you've been talking about this, and I'm sorry that I didn't understand. But if I incorporate in Israel versus America versus Europe, what are the practical, I don't know what the word is, I guess, consequences of that choice? Yeah.
Yeah. So it really depends. It's mostly tax issues. And has to do also with regulation. For instance, we have one large potential LP, potential investor, who told us that if we incorporate the fund in the Cayman Islands, then it's a no-no for him. It doesn't even gonna talk to
Why?
us.
Why?
Why? Because so-called Cayman was put on the gray list of money laundering. So
Oh,
these and then the other clients for whom now Israel it was probably actually the easiest and the cheapest and the fastest jurisdiction. For me, would be the best. But the problem is many people are not so familiar with having to deal with an Israel entity, and therefore we want to give something to the clients, to the LPs, to the partners, something where they are, comfortable working with. So it really has to do with tax issues, with regulation issue, because we want everything to be kosher, to be legal, and to be completely white, and we don't want to have issues like that. And we want also something where people are simply comfortable. It's not so easy. So we may have to end up at the end of the day, as I said, to have a different jurisdiction. Just for you to understand, we got quotes in terms of just how much does it cost to create a fund for some of the people who actually considering of creating a fund. So just the running of a fund in Luxembourg will cost you at the very least 250 to 200,000 euros, not dollars, euros a year.
wow.
That's if you
Wow.
have a little fund. A little fund. If you have a big fund, I mean, when I said $200 million, it's not such a big fund. But for 200 million euros, it's going to cost you close to 400,000
My God.
euros a year. That's just
Crazy.
the running cost of the regulation and running cost of the fund, nothing else, right?
That's
Now
so crazy.
in America, creating a fund is quite expensive because American lawyers are very expensive. So it will cost you at the very least $50,000, and it can go up to $200,000 to $300,000 just to create the fund. If you, but then running costs are much lower. If
Okay, so
once everything's
I have a few questions, but I just want to repeat what to the people watching. If you have questions on anything to do with the venture game or entrepreneurship or whatever, ask them. I'll put them on the screen and we'll address them. So feel free to ask questions. Amir, talk to me a little bit about. I want you to talk to me about three things. Okay, a term sheet, a capital, and money under management. Three terms that you hear all the time when it comes to VCs. They give you a term sheet, meaning they're basically making an offer to invest. The cap table is, who has parts of my company, and money under management is the money that, let's say, the VC can use. No, a percentage of that. Sorry, the VC can use to pay his salaries and things like that. But tell me all about those three terms and what they
okay.
mean.
Okay, so first of all, you know what? I'm going to start with the last. I'm going to start with the assets under management. Assets AUM, so called. Assets under management is simply how much money you have raised from LPs, from partners, from investors. Okay, VC typically is an industry where there is less money, much less money than private equity. Private equity, really, we're talking really about different stages in the lives of companies, right? VC is the first stage of the company. It's early stage relatively, and then you move into private equity, and private equity is a stage where the companies are much more mature. Now, because companies are much more mature, then the quantity of money is much higher, right? But I would say a typical venture capital fund is probably going to be in Israel is going to be between 50 million for small funds to maybe 300-400 million, 500 million for big funds. Very big funds in terms of one fund. Generally, funds are going to be 200 million, 300 million, not much more than that. It's quite seldom.
Let's answer this question from Farid. This is a question that just came in.
What is the best place for VC with minimum cost for winning? So it really depends. As I said, depends. Who are your LPs? What's your basis? Because there is not one answer fits all. Because if all your LPs are going to be from the European Union, you may have no choice, but also for regulatory reason, but to create a fund in Luxembourg, really, with all the costs involved, no choice. In some cases, if all your LPs are going to be from the United States, then you may want to have a Delaware fund, and maybe also an offshore structure for some U.S. investors who do not want to invest in the U.S. It also happens. So you could have a Delaware fund with a Cayman fund, or only a Cayman fund. Really depends. It's not there is not one. That's the point that I was trying to make. There isn't such a thing as one answer. It really depends who are your LPs.
Okay, what are your thoughts on the difference between seed 2 versus Series A rounds?
Okay, I tell you what, my feeling is that seed is it's very important because that's where that's where the story starts. You have to go through seed, right? But I would say it's it's almost random. It's extremely difficult to make a judgment call. Some people are great at that. I'm not so great at a very early stage. So I prefer to go a little bit later. We want to invest in Series A, Series B, where we can feel that there's already a technology, that there's already company. The risk has gone down a little bit. It's still relatively early, but not too early. So everybody's trying to find his own space, his own place in the ecosystem. That's where we feel we have an advantage. Is more Series A to Series B.
How would you define though? How would you define the difference between a seed 2 fundraise and a Series A? Like where's that? How do you define the difference?
It's difficult also because these things are not entirely clear cut. I would say that seed is when you are in seed, probably you're still taking the technological risk to a large extent. Series A, you are more already the technology is already and the business strategy is more in place, and it's generally before you have revenue, just early revenues, but you have already a product. You can see already where this is going. And whereas pre-seed is really when you have nothing, when you have a piece of paper, an idea, and seed is where you are at the beginning of creating technology and don't even know there's real interest or that even it's working. That's probably what I would say.
Okay, let's answer this question.
What kind of team does a VC typically employ?
Yeah, tell me about your team.
Yeah. So, well, it really depends also on the size of the shop, because some of the larger VC funds that we have in Israel, I'm not even talking about the very large VCs in the world, but some of the large VCs in Israel, they have large teams, right? A lot of analysts and technological advisors and people who deal a lot with the ongoing, I would say, running of the business. Whereas, of course, such a fund as ours is smaller, so the team is smaller. So we have to rely more on, I would say, external advisors and having people who are able to give us professional advice on some technologies. But at the end of the day, I would say that also our team is in the process of being built, but we have already people with us. So I would say we are going to have one person who is going to be, let's say, a COO, a chief operating officer, who is going to be in charge of all the technical running of the fund. We're going to have a couple of analysts because nobody can really go through everything through the hundreds of companies and just too much of a volume. So you need people to help you. But at the end of the day, I would say that the judgment calls of where to invest at the end of the day are going to be made by the partners themselves, which is my partner, Amir and Gigi, and myself. And of course, we have a very distinguished advisory board, including Hillel. And I trust Hillel, and I build on him to also help us with the deal flow. And because at the end of the day, you're going to need to make a choice among hundreds of companies, right? We, at the end of the day, going to pick up 15 to 20 companies maximum during the whole lifetime of the fund, out of probably hundreds that we're going to see every year for a number of years. So maybe 1,000 companies altogether, 800, 1,000, 1,200, I don't know, something like that we're going to be seeing. So we're talking about 1 or 2% or 3% of all the companies we're going to be seeing. That's where we're going to be investing.
Okay, let's. We're short on time because we said we'd do 30
sorry.
minutes. We'll go a little bit over, but what is the level of engagement in the company you invest in? In other words, you invest in a company. How hands-on do you get with that company?
Well, personally, it's a very personal question. Not everybody is going to be the same, going to give you the same answer, of course, because it depends on the strategy of the fund. We are going to be, I would say, opportunistic about it. In other words, in some cases, we're going to be very hands-on if we feel we can bring value to the company, including being lead investors. In other cases, where we're going to simply going to be able to tag along, I don't have a problem if the company is well managed. We may be doing some purely financial investments where we see that they don't need us very much, and we're happy to help here and there if we can. But we may have in some cases, a lot of value, other cases, less.
So I think to answer that question, maybe the fundamental answer here is that a good VC knows that he or she is working for the entrepreneur and not the other way around. Completely. Right? A lot of times, in certain places, a VC might be like, on his or her throne and seeing deal flow and kind of like the emperor, thumbs down, thumbs up, and like, that's it. You write a check, no. The VC is supposed to work for the entrepreneur and not the other way around. And that's a really important distinction. And that's the difference, by the way, between good VCs and bad VCs. You look at VCs like Andreessen Horowitz or Excel or Lightspeed or Benchmark or Sequoia. These guys, like, they go to the end of earth for their companies. There's no limitations. Michael Eisenberg from Aleph literally gets on the plane to go to Silicon Valley to recruit talent for his companies. So It really depends, on the model of the VC. Are they a value add VC, or are they just, quote unquote, dumb money? And I know that Amir, I know that Champel is definitely not dumb money, and that they are there when their entrepreneurs need help. But on the other hand, when the entrepreneur says, "Listen, back off," they would never say that. But you know what I mean? Like if they don't want help, then Amir's not the type of guy to kind of stick his nose where it doesn't belong.
Exactly. Exactly.
Bernard,
that's exactly what I meant. I just want to add one sentence. It's very important. Is some VCs are very, very aggressive, and they want the company to be managed the way they want. And we don't believe in that. We don't believe in that at all. We believe that we are investing in investors, in entrepreneurs, and we believe that these entrepreneurs, at the end of the day, are the one, they know their companies. It's their business. We are here to help. We're here to invest. We have to do everything we can to help the company grow. But at the end of the day, we are not the ones managing the company. This is only in very, 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 very extreme cases. We don't want to be there.
So I'll now add one sentence to the sentence that you added. I think if I would coin, or give it a name, I think the job of a VC is to empower entrepreneurs, right? And, again, I think there are some VCs that maybe stick their nose where it's not wanted. And there's some VCs that don't help when they're needed. But the goal of a VC is to empower entrepreneurs. So Bernard asked, what is the frequency structure of the contacts with the companies? How often do you speak to your companies?
Well, it depends. It depends when, it depends which companies. Again, some companies I have very little contacts because they don't really need me. In some companies, I'm in touch with them all the time, or in some periods, literally every day, and then in other periods, not so much. It's really dynamic. It depends on the needs of the company because it's linking. It's very much linked to what you said. We're here to work for the company, right? To help them. So it depends. Sometimes they need a lot of help. Some companies need more help. Some others don't need so much or less. Sometimes more, sometimes less. It's really very depending on the circumstances. But yes, we want to be here to help as much as we can our company succeed, because at the end of the day, we understand that their success is our success. We're partners at the end of the day.
Okay, let's talk for 2 more minutes about Champel. Okay, so tell me a little bit about your investment criterion, right? So in other words, you see tons of entrepreneurs. When do you decide, or how do you decide to invest in a company? What stage? Are people more important? Is technology more important? Is an idea more important? Is the market more important? What do you look for when you deploy capital?
Well, the short answer is everything is important. But at the end of the day, we are making, the most important is we're making a bet on people. That's what I believe. I believe at the end of the day, of course, has to be a market. Of course, the technology has to work. That's obvious. We all understand that. If it's not working, it's not working, right? But at the end of the day, especially at this stage of the company, you have to believe that the guy is going to have execution abilities. and you have to believe that he's got what it needs, what it takes to take a company from essentially from zero and make it a success. And that's what we're trying to do. We're making bets on people.
Love it. Okay, so before we get off the stream, tell me a little bit about how much money you're raising right now, and kind of, what type of companies, or let's say sectors or verticals, you do not invest in.
Right. So eventually we would like to get to around $200 million. We are not going to be investing in cybersecurity. Why? Although it's probably the hottest vertical in Israel. But the reality is that there are people who've been investing in this vertical, in this industry for years. They know everybody. They've got...
Like Glilot.
Right. Glilot is an amazing example. It's amazing fun, amazing people. They have all the know-how, the network, their understanding of the market. They're going to get the good deals, right? What am I going to get if I go and invest there? The reality is that to the extent I get something, I'm probably going to get only the deals that nobody else wants to, right?
Wait a second. You keep me as an advisor, you'll get the best deals.
Listen, we have a part of the portfolio which is technically open also for that, if we can justify it. But in reality, it's going to be very difficult to have access to the best deals. And at the end of the day, VC is a business where your returns are dependent on the deal flow, on the ability to access the good deals. That's why.
How fast do you move? If I bring you an idea today, how quickly can you write a check?
Today, no, but hopefully we're going to have our fund in I would say October, November. We're going to be able to once we have the fund, count a week.
Love it. Okay, Yair, last question. What advice can you give a student who is motivated to enter into the VC world? Amir, with your permission, I'm going to answer that question, okay?
No problem.
Yair, my advice to you is don't. Don't. And I'll tell you why. I said this in the beginning, but it's really important. People don't understand the job of a VC. People glorify it and think, a VC sits on his throne and just sees deal flow and yes, I'll invest here, take money. It's not like that. A VC sits, I'd say 85% of his or her time in boardrooms and Excel sheets. And out of the rest of the time, 90% of it, they're saying no to entrepreneurs. And only a small, tiny little sliver of their time are they actually deploying capital. So truth be told, I would not, listen, I respect and admire so many of the VCs in this country, but I would not recommend anyone go in this profession, especially given how many VCs there are in this country. We're getting to the point that it's just gotten so saturated. There's literally tens of VCs in every single stage. Seed, there are tens. A, there are tens. B, there are 10. C, growth, private equity. There's just so many. And so to differentiate yourself and to get the best deals today would be extremely competitive and extremely difficult. So I would not recommend it.
Yeah, you need to really, that's really how we thought about it, because exactly of what you said is to really go and look for the right niches. And it's not easy. It's really, really not easy. I hope we're going to be investing in food tech, agri-tech, Series A, in bioconvergence and medtech, which is a fascinating topic. Also Series A and a couple of other niches where we feel it's not completely overcrowded at this point, and I'm sure in 3 or 5 years from now it will be. But so far we think it's still interesting. But you're right. It's not easy. One thing I would say is you need to bring with you extremely good, added value and professional knowledge. That's one thing I could say. If you are the best in one specific domain that you really know it very, very well, then you have a shot.
Okay, so two last things. Number one, before I ask my last question, if you guys are watching this and it's beneficial for you in any way and you find value here, feel free to share this on your stream in LinkedIn, Facebook, or YouTube, because I feel like this could be, not because of me, because Amir brought incredible insights that I think could be.
No, it's because of you. Don't be.
Okay, how about this? It's because of my good looks and your good brains.
Okay.
No, but seriously, guys, if you're watching this is helpful for you, then by all means share it. I want to ask Amir one last question. We talked about investing in people and obviously the market and ideas and everything we talked about. I want to know what emphasis you put on a lead investor, meaning if a company comes to you and says, look, here's who invested in me. Do you want to join? how seriously do you look at that lead investor and say, well, if they invested, I'm in? Is that like a big consideration of yours, or you just do regular due diligence?
No, it is a consideration. It was, you know what? I'm going to answer like that. It was a very big consideration when we started, because when we started, we did not have the financial depths to do all the due diligence on ourselves, and it was very important who was leading. That was clear. Under our new fund, where we are going to have more financial depths and we're going to have more means, it's going to be less important, especially as we're going to go in relatively early. And I'm happy to lead rounds in many cases. But it is still important to see who are the investors, because one thing is clear is that, and that's what I like also about the VC. I mean, there's a lot of competition, but it's also a collaborative game. You don't do it on your own. Correct me if I'm wrong, but all the great successes in the world, I don't think there are very many, if at all, companies where there was only one investor or one lead investor. I think in pretty much all cases, you had a consortium. So it's important to be not alone and to be surrounded with good people and to do that together. I think it's very, very important.
All right, I'm going to answer Daniel's question real quick, and then we're going to end the stream for now. And guys, like I said, if you want to share it, I think there's some great insights being given here, and I think it could really help your audience. Daniel asked, would love to hear in the future about how companies are growth-driven to get funding without being profitable. So I'm going to jump in and say, I don't know if you understand that in tech, profitability is not a criteria for investment. In other words, if you look at the biggest companies, take Amazon as an example. Amazon was not profitable for most of its life. It only became profitable, 6-7 years ago because of Amazon, because of AWS. Amazon.com wasn't profitable until recently. And so, when you're focused as a tech company on growth, you're not focused on monetization. You're focused not on profitability, but on growing and expanding. I always like to give the example of a lemonade stand. When I'm 8 years old and I want to build a lemonade stand, I have to go buy a table and a tablecloth and a sign and lemonade and water. I'm investing in the company. I'm not profitable, but I'm not losing money. I'm investing in the company. And then when I start selling it, eventually I become profitable, but I can't do both. I either need to spend the money to grow the company or focus on profitability. And so profitability is not something that a VC says, oh, you're not profitable, I won't invest. It's things like, are the founders capable? Do they have a track record? Is the team strong? Is the idea, defensible? It's possible to defend it. Is there a barrier to entry? Is there IP? Is there technology? What's the go-to-market? Et cetera, et cetera. What's the business model? So profitability, I don't think is even an important. In fact, I'll tell you even more. I think it was Mark Andreessen who wrote an article that said, if an entrepreneur comes into my office and says, here's my product and here's how we're going to make money, the conversation's over, because he doesn't want to know in the first meeting how you're going to make money. He wants to know how you're going to change the world. And then later on in the meeting, third meeting, fourth, you could talk about a business model. But profitability is not and should not be on the mind of an early stage entrepreneur. You should know in your head down the road how in theory you're going to monetize. But for now, focus on growth. Do you agree with that, Amir?
Completely, yeah, of course. More than that, what does it mean to be profitable? To be profitable means that you're essentially taking the resources of the company is creating to your pocket, which is great at some point. But for many years, you don't want to take these resources to your pocket and go and buy yourself a nice house. What you want to do is to take these resources, put them back into the company, and use them to grow until at some point the company has conquered the world and has made so much money that there is less room to grow.
Daniel, this comment, in my humble opinion, I'm sorry to say so, I completely fundamentally disagree with you. It's not wasted cash when you're investing in human capital, when you're helping retain your employees by giving them trips and parties and making them happy. Then you're not wasting money. You're investing in the company, which is exactly what I just said. You're buying a table and a tablecloth. That's exactly what you're doing. You're investing in your employees to keep them happy. So that's not a waste of money. It's extremely important. And in today's day and age, when there's so much competition and everyone's trying to recruit talent and poach talent, and you need to keep your employees retained and you need to treat them the way they deserve to be treated. And on that note, guys, we went way over time. Maybe we'll do this again if you guys enjoyed it. But go and share this because I think it was incredible. And Amir, thank you for your time. Good luck on the fundraising. And let's go kick some butt. All right?
Bye.
Bye, guys. Take care, everyone. Okay, let's see how you end this broadcast. End broadcast.